Hello, everybody. This is Kama with the online talk show Kama Speaks. And today, Kama is speaking with Brian Sapp. He is a loan officer at Wholesale Capitol here in the beautiful Moreno Valley. Real estate right now is a big question. Everybody wants to know, can they buy? Should they sell? Can they purchase after they foreclose? So I decided to do a show called Ask the Lender, where you can ask the lender whatever questions you may have. Whether you're watching this now or you're watching it later, you can still type in your questions, and I will make sure that your questions get answered. I've been in real estate as a realtor for the last 9.5 years, and I absolutely love what I do. So it's important for me to make sure that you are educated in real estate. So I want to welcome my guest, Brian Sapp. Thank you so much for being on the show.
You're welcome. Thanks for having me.
All right, if you can, I would like for you to let the audience know just a little bit about your background before we get into all the questions.
Okay, no problem. Well, I got into the financial services business, which included mortgages, back in 1989. I was just out of the Navy, and as usual, when you get out of the military, you're trying to find something else to do. So, had a few different jobs, and eventually landed with Transamerica Financial down in San Diego in a management trainee position. From there, went to a variety of different jobs related to that, and eventually ended up with Wells Fargo. Okay, now I handled two areas, mortgages and autos. So over the last 25 years, I've kind of spent half my time in mortgages and half in auto finance. So pretty well-rounded experience. Right now, I work with Wholesale Captiol Corporation, a direct mortgage lender, and I'm a mortgage consultant. And I've been with them for the last 6.5 years. So we handle a variety of products, FHA, VA, and conventional products, and including down payment assistance programs for a lot of first-time home buyers.
Okay, well, before I get in questions, I see we have viewers. If you are watching and you have any questions, make sure you type them. If you don't get your questions answered because I don't see it, make sure you go back to my Facebook page under the event page and type in your question. Okay, now, being a realtor, one of the questions I get all the time is, how soon should I begin to get myself together for looking for a house? So I have people that I know for sure that their credit, they say, is not that good, but they want to wait a year because they're trying to fix their own credit because they think if they do X, Y, and Z, it's going to work. How soon should they talk to you before they just go in fixing their own credit?
I would say on average 3 to 6 months.
Okay.
If it's someone who's had problems with their credit, maybe even 6 months would probably be more ideal. That way I get a chance to get a full view of their credit profile, including their income, and then work on any problems that may have resulted from the past. So I would figure if credit problems about 6 months, if you're pretty sure that no issues with your credit, in other words, your credit's pretty clean, I would still say 2 to 3 months would be a good idea. That way we get to look at options and any programs that may be available for you, and then just get an idea of what's going on out there.
Now, a lot of people, they don't like to get their credit ran. That's one thing people always ask me. I know some people are not educated. This is why I do things like this. But explain what the process is before they can go out with the realtor. What are the steps that you take, and what do you require for those potential borrowers that are looking to purchase a property?
Yeah, that's a really good question, because many people in it used to be that if you wanted to go buy a house, the first thing you do is pick up a phone and call a realtor. Nowadays, with credit scoring and with knowing how important the credit function is in buying a property, it's actually the other way around. You would want to go ahead and give us a call first so that we can take a look at your credit. Now, pulling your credit, I know that now that everyone's made such a big deal about FICO scores and inquiries, things like that, people are a little bit more leery about having their credit pulled. But this is not quite like going down to an auto dealership where they run your credit a number of times. By going to a direct lender like myself, we'll run it one time. We'll get a tri-merge credit bureau, which is the three main bureaus, TransUnion, Equifax, and Experian. and that way we get a clear idea of what's going on. Um, Even if you were shopping, let's say you were to go to 2 or 3 lenders just to see what your options are, that really won't hurt your score very much. On average, it may be a point or two if you were to just say maybe go to 2 or 3 lenders. Now, if you just go crazy and go to 8 or 9 or 10 in a short amount of time, that could impact your credit scores. But just going to a lender or two, that really won't affect you very much.
Okay. And how much should one have to save to purchase a property?
As much as you can. No, no. Well, in general, it's well, we'll go down the line. If you're a veteran, which is one of the best programs, if you're a veteran, that's a VA loan. There's zero down payment. Even in the case of no down payment, you still want to have at least 3 to 4% of whatever the purchase price will be. So to make it easy, if it's $100,000 purchase price, which we know we won't find anything there, but if it was that, just to make it easy, $100,000 purchase price, you want to have about $4,000. So if it was about $200,000 for purchase price, I would say you really want to have about $8,000 that you want to have saved. If it's an FHA loan, you're looking at a 3.5% down payment. So let's use $200,000 again. 3.5% down payment, that would be $7,000, and then you'll probably want to have an equal amount for closing costs. Okay, now if it's conventional, the minimum down payment is 5%. So if it's a $200,000 purchase price, you're looking at $10,000, and then again, like I said, 3.5 to 4%, you're looking at another maybe $8,000 or $18,000 altogether. So it really helps you to have some cash. The fact that a seller may help you with closing costs may help you keep some cash in your pocket, but just to figure worst case, that's what you're looking for. You want to make sure you have enough money to be able to take care of any down payment or closing costs that come up at the end of escrow.
And that was one thing that I wanted to mention as well. Being a realtor, people ask, well, won't the seller pay the down payment or the closing costs? I'm sorry, give 3% towards the closing costs, and I let them know it is not guaranteed and it's nothing that they have to do. That's something that they can do because this is digging out of their pocket. They want to give 3% of the purchase price. If it's $200,000, you're asking for 6%. I'm sorry, $6,000. That's up to them whether or not, but always be prepared just in case. It would be great if they're able to pay that. Then that's money you can put towards the home to purchase, maybe a brand new appliances or maybe paint the color you want to and do some things within the house, but always be prepared no matter what.
Exactly, and there's a couple techniques that Kama already know that you can use. Stacking the costs, which basically means that if you're looking for the seller to give you a certain dollar amount to help with closing costs, you can actually increase the price of your offer if values are able to support that. In that way, you can basically increase the purchase price of the property, giving that seller the net profit that they need, and also enable them to get credit you back the closing costs that you need to take care of your closing funds. That will help you keep some money in your pocket.
Yeah, that's a great point that you said, stacking the closing cost. That is something that you can do, and guess what? Now it doesn't affect their bottom line because that was money that they weren't budgeting for anyway. So it's a great way to try to get the property approved to get closing cost. Now you mentioned conventional, you mentioned FHA.
Right.
People are always back and forth as to what's better, which route they should go. Can you just tell us a little bit about the pros and cons between FHA and conventional, and maybe who should choose what, or if it's a case by case circumstance?
Got it. Good question too. And if you're not a veteran, again, like I said before, I'm a veteran myself, so having that VA program where there's no down payment is great. But if you're not, then you have to look at your options at FHA or conventional. FHA gives you a lower down payment, and historically, that was a great program. What has changed it somewhat is that FHA over the last few years, in going back to the recession and the fact that we had so many houses that went into default, the mortgage insurance for FHA, and I'll back up just a second. Mortgage insurance is what protects the lender against default by the buyer, except that the buyer pays for it. So in the case of these low down payments or minimum down payments, there's mortgage insurance involved. So comparing FHA to conventional, FHA will give you a lower down payment, but in general, you'll have a higher mortgage insurance cost. Now, you'll have to compare that against conventional that have a minimum down payment of 5%. You'll have a higher down payment, but if you have a decent credit score, most likely you'll have a lower mortgage insurance cost than it would be for FHA. So it really comes down to once your lender has run your profile and they'll lay out options for you, it comes down to the numbers. Um, what's going to be the largest out of pocket cost for you? Now, one other thing too to consider with FHA, at least as of the changes from last year, with FHA, the mortgage insurance stays on the loan for the whole life of it. So if you have that loan for 30 years, you'll keep that mortgage insurance and you'll have to pay that. With conventional, you do not have that requirement. All you have to do is satisfy the fact that you have at least 20% equity in that property, and you should be able to get it removed. So that's something to consider too. If you're planning to live in your home, say more than 3 or 4 years, you have to look at that variable as well. So it's a matter of out-of-pocket costs and how soon you can remove that mortgage insurance and save yourself some money.
So for someone that has 20% equity in their property, they are able to remove the mortgage insurance through FHA?
No, unfortunately, no. It used to be before last year, FHA had a minimum of 5 years that you had to keep the mortgage insurance, and then you would have to be at below 79% loan to value. That's your loan amount compared to the value of your property at the time. Now that the rules have changed, when you get an FHA loan, you'll have that mortgage insurance for the life of the loan. So as long as you have that FHA loan now, you'll have that mortgage insurance. Now you do have the option of refinancing out of it, and it may be that at the beginning going FHA may be cheaper. But if you have that loan for several years, you may want to look at the fact of or the possibility of refinancing to conventional so that you can remove that mortgage insurance.
For those that are purchased before 2013, are they able to remove the mortgage insurance? Such as my property, we purchased 2006,
Yes.
and I know there's well more than 20% equity, thank God. Would we be able to remove the mortgage insurance?
Yes, you should be. Now, each mortgage servicer, the one who accepts your payments, are a little bit different on their procedures. But in general, if you're able to show them that you're past your 5 years of paying on your loan, and you're below 79%, either by showing them comparable sales, or if you have to, having an appraisal completed on your property, that should suffice to show to remove that mortgage insurance requirement.
Okay. Okay. Many people right now are still losing their property. We're still have people that are going through foreclosure, believe it or not.
Yeah.
A lot of people think that the foreclosure wave is over and people just own their property outright. Now,
Right.
because people are still losing their property, they want to purchase a property after the foreclosure. What programs do you offer, or how soon can they purchase a property after their home has been foreclosed upon?
Great question. In general, we'll just go with the standard programs, starting with VA. VA, again, a great program, is the most lenient. Normally, you only have to wait 2 years after a foreclosure has been completed. Okay, and that will go from the date that the property transferred back either to a lender or to someone else who bought it in the foreclosure auction. For FHA, it is 3 years, and for conventional, it's actually up to 7 years. Now, there's exceptions to that, but it's pretty strict on having that removed. Since so many people lost their jobs in the recession, we're really unable to use that as a reason for, I guess, an event that would cause an exception. So as I said before, VA would be the most lenient, 2 years, FHA 3 years, and conventional between 4 to 7. And most likely it would be 7 years that you would have to wait. A direct lender like myself, we do have programs where niche programs where you can actually get around some of those requirements, but that would involve usually 20% down, 20% cash down payment.
Well, let's talk about the mortgage alternative program
Mm-hmm.
and what that has to offer.
Right. That's a great one. That's something that's just come up for us. The program's been around for about 2 years now. I want to say it's in about 15 states, including the California. And if you have a minimum 8% of the purchase price, then you and the ability to make the monthly MAP payments or mortgage alternative program payments and show that you're on track to get your credit resolved, then you could use this program. Um, Basically, it allows you to, with the investor's help, go ahead and buy that property. You contribute your deposit, and it's basically broken down like this. The 8% is 5% deposit, which is held in a separate escrow that when you're ready to buy the home, you can actually use for your down payment. And then 3% as a transaction fee for the investor. But it allows you to be able to get the keys to that home, make any improvements that you want to make, and starting from the 91st day from the time that you have the keys to that property on up to 6 years, you have a chance to resolve your credit issues and then get financing and buy that property. Great program.
Are you able to help someone that has bad credit? Do you help them go through the process, or do you have a credit restore company you work with? How are you helping those that need help to get their credit repaired or restored?
I do it myself, and I don't charge anything. Basically, when you're resolving your credit, it's really issues that you can resolve yourself by going through a format that's already laid out for us. There are credit restorers or credit repairers, and many of them charge a hefty fee, but ultimately they're only doing what you can do yourself. And if you knew the procedure, and I could walk you through that, it's really a matter of you following those steps, asking questions from me, and then just following up with the process as you restore your credit. So I would always suggest, if you have any time at all and willing to do a little bit of footwork, do it yourself. Get a professional, someone like myself or you, comma. As a matter of fact, anyone who has insight to how the credit repair process works, and get started that way. It'll save you a lot of money.
Okay. I want to get into refinancing.
Mm-hmm.
There's people out there that are, I'm sure, currently refinancing their property, because I know of people that actually are in the midst of losing their property and they have equity.
Yeah.
Those are people that usually have to go through a loan modification. But for those that are paying on their credit, what is it looking like for those that either want to do a refinance or a home equity line of credit?
Wow, that's a good one. And a lot of that is case by case, and it's frustrating now that we actually have equity to deal with in a lot of cases, that people are still losing their homes. And many times when they're losing their home, if they have equity, then it may be just a matter of them not getting the right information and not reaching out to a licensed professional, or maybe even to their own mortgage company.
Mm-hmm.
I would suggest, if you're in trouble, start with your mortgage company, your mortgage servicer, talk to them, see what they can do to help you with either a modification on your loan. If that's not possible, and you still want to stay in your home, then you may want to look at some options. Your credit will matter at this point, so income and credit will still matter. So if you've been behind, it gets really tough to be able to refinance unless maybe you're looking at a private source of money. Some people would call that hard money sources, where you may have to pay more interest. Another alternative would be to sell the home. You may get a chance to. As a matter of fact, I just had this circumstance with a former client of mine, where she was able to sell her home, get about $30,000 cash, and with that, she can now start to repair her credit and get a new start. So those are some of the options if you're in trouble. But it gets tough to refinance if you've been behind and unable to make it up. So start with your mortgage servicer to see what they can do.
And then what, if you can just explain a little bit about the home equity line of credit, because I noticed some people are actually inquiring about that because they have the equity and they want to know, should they do a cash out refi or if they should do a home equity line of credit.
Got it. It comes down to the numbers on that. Depends on how much you want and what your bill structure looks like. If and that's a great question. It's something we're dealing with quite a bit. We're getting those types of requests now that people they have equity. They will either want to fix up their home to sell it, or they just want to fix it up and get it after years of not being able to do anything to their home. They want to maintain their property now. If the numbers work right, and you may be even able to save some money, I would say a refinance with cash out would help you because rates are really low right now. If it works out that the refinance with cash out doesn't help you numbers wise, I would suggest getting an equity line of credit. You could start with me, but I'll be honest with you. A lot of times, I would suggest first you may want to check with a credit union. Credit unions offer really great terms on home equity line of credits, so that's a good way to start. I'm not trying to give away business or anything like that, but for me to really help you, it'd be best for me to give you the best advice, and I would start there. Okay. Usually, credit unions aren't as competitive in the purchase market for homes, but when it comes to equity line of credits, they seem to have products that really work out well for that circumstance.
Okay. Now we have a few more viewers on. If you're watching, please feel free to ask questions before we wrap up. We only have a few minutes here, and I want to make sure if you have any questions that you're able to ask the lender. Now, there's some people out there that are ready to get into investment. They don't have the cash to pay. They don't have the money to pay cash, but they may have enough money for a down payment. How much does one need to get into investing for a buy and hold? And do you have special programs for a flip, or would that be the same type of program?
Well, we do have niche programs for investors. There's a variety of them, and depending on your situation, I would suggest a lot of times if you're able, I mean, whether you're just starting out or even if you already have a home, if you're able to buy that property as owner occupied, that might be your best way to go to get in initially, especially if it's your first time. Your overall costs are lower, your interest rate will be lower, and down payment requirement will be lower. Okay, so that's what I would suggest, and from that point on, getting a renter will help you. That way you have your best chance of getting a net profit on that property or minimize any, I guess, negative income that you might have on that property. That's what I would suggest. You can use the similar programs, whether it's VA, or FHA, or conventional, and we do have our niche programs. But if you're just getting started and you're able to do that, that's the way I would start. If not, you're probably looking at minimum 15 to 20% down. If it's more than one unit, you're probably looking at 25% down. So the down payment for that is hefty, but the good thing is that with the rates the way they are, you still stand if you have a decent credit score to get a decent interest rate to help with that.
Yeah, I still hear people say, "Oh, I'm waiting for lower interest rates," and some people, which you've been in the industry for a while. I helped someone about 2 years ago. One of my family members had a 10% interest rate that she had never received a loan modification on.
Right.
And they hadn't reached out to her either. So people are thinking that the interest rates are high. They're still waiting for them to drop, and they don't understand where the interest rates were probably even before you may have gotten into mortgage. I've heard interest rates being as high as 17%. How stable have we been with the interest rates, and what is the average that the interest rates have been up to this date? Because I know that interest rates change every day, so it's hard to say the interest rate is going to be 4.5% today or for the rest of the month, because I know it fluctuates.
Right, it does. As a matter of fact, it changes twice a day. You just go off of the stock market when it opens and when it closes. So we get a midday adjustment. It starts off in the morning. We have our pricing, and then around 1 o'clock we'll get an adjustment, which is pretty much coincides with the closing of the stock market for the day. So there may be some fluctuations. Now, if you want to get historical about it, interest rates started to be measured back in the 50s, and when they started, they were right around 3.5% back then. So we fluctuate. We've gone up and down with the economy. And when I started in the business in '89, if you believe it or not, um, purchase money rates were about 18%. Okay, it was somewhere between 16 and 18%. And if you wanted an equity line of credit or a second mortgage, you were looking at about 21%, if you can believe that. Yeah, wow. We had just come out of a recessionary time, the thrift and loan problem that we had back in the '80s. So rates were really crazy at that time. Um, since that time, obviously, we've gone down quite a bit. I want to say around 1991, we hit around 10%, and we've been below that pretty much ever since. Uh, 2 years ago, we we pretty much dropped all the way down to where we were back to the time when we first started measuring rates. We literally had rates in the low 3%, and some people were even getting just below 3%. I doubt that we're going to go back to that time, and it's really simple. It's just like what you're hearing in the news, the business reports. Our economy is getting better, and what had happened is that the government helped to keep rates down while we were in that recessionary period by buying treasury bonds. Now, as employment reports and production reports get better, the government is beginning to back off of buying as many treasury bonds to keep rates down. To balance that effect, though, even though the government is backing off, we have some geopolitical problems out there in the world. The different wars that we're hearing about, some economic problems that are happening in other countries still. So that's kind of balancing our effect. Right now, we're in the 4%, mid 4% range, and we've been that way since the beginning of the year. It really hasn't changed very much. We anticipate if the pressure continues, and what I mean by pressure is that if the the economic reports continue to stay positive, we may go as high as 5 to 5.5% by this time next year. Now,
Wow.
yeah, now, but you got to remember, 3, 4 years ago, 5 years ago, we had rates in the mid 6% range, so
Yes.
that would still be good. Those are great rates. Now, a lot of people they hear the advertising and everything like that, so it has them, it leaves them with an impression that those rates are bad, but you just have to look at it overall. Those are great rates, and from what the experts say, the affordability factor, if pricing continues to have a slow rise, there'll be quite a few people who are able to afford homes at that time.
Wow.
Yeah.
Well, for those that are watching, please make sure you take heed to that. That way you're educated. This is all about education, listening to the professional that lets you know we are still in a very good place. Again, for those that are watching, if you have questions, you can put your questions, type your questions out. I've been checking to see if we have any questions. We don't have any from the audience right now, but I know those are definitely some frequently asked questions that people come to me and ask about. And before I let you go, I do have one question. Can a person buy down a rate to get a lower rate?
Yes, definitely. The process for me when I have someone come into the office or when we're about to lock rate, I we look at several scenarios because there's a couple ways to go. Not just buying down rate, but also back to down payment and closing costs. You can buy down the rate, and you got to think about it. It really comes down to how long you plan to stay in that home. Um, the average first-time home buyer stays in their home 3 to 4 years. If that's the case, you may want to look at a rate, a midpoint rate, where you may actually be able to get what they call a rebate or lender's credit to help you with some closing costs, especially in a case where the seller is not willing to help you with any closing costs. So, for example, let's say the rate today is 4.5% at, we call it par or even. That's a point where for getting that 4.5% rate, you neither pay a cost for it or get any lender credit to go with it. Now, as you go higher in the interest rate, on the interest rate scale, you can get more money back to help with closing costs. But if you're looking to say get the lowest possible rate, we can go the other way. We can go down the scale. So if you want to say a 4.5, 4.25, 4.25, or 4% rate, you would possibly pay a fee for that. So it's just a matter of thinking how this affects you. A lot of times when people buy down, how I try to frame it is you're going to pay a certain cost for that rate. Now, how many months of savings would it take for you to balance out on that? So if it cost you $500 a month to get a lower rate and the savings was $50 a month, it's going to take you 10 months of that savings to recoup that $500. And after that 10 months, it's all clear savings for you. So that's how I would frame it. But yes, you would be able to either buy down your rate or increase your rate so that you can get cost of money to help with your closing costs.
Okay. Well, I want to thank you so much for being on the show. Before I let you go, let people know how they can get in contact with you.
Oh, great. Thank you very much. And I'm available today, by the way. Well, you can call me toll free. I generally work throughout Southern California, and I'm able to work throughout California as well. But toll free, it's 866-812-8192. If you're more local, you can call my direct office number, 951-488-3118. And if you want to reach me by email, it's bsapp, that's B as in boy, S as in Sam, A as in Apple, two P's as in Paul, at wccloans.com. Be glad to answer your questions and be glad to get you started.
All right. Well, thank you. I'm still checking. I just don't want to miss out on anybody's questions if they have them. So we have no questions from the audience. Hopefully I was able to successfully answer all the questions that came that may have came to mind to some people. So again, thank you so much for being on my show. I appreciate it. Brian is someone that I have linked up with in the last few months. I've actually worked with his company on several deals, and I must say they are the top company that actually close deals that they say they're able to do, and they do it in a timely manner. I don't believe I've had one deal that went more than 30 days. As a matter of fact, they always seem to come under 30 days. And I absolutely love working with a lender like that because it's important that you're just not working with anyone. Make sure that your lender is reputable. His company has been in business for how many years?
Just over 20 years now, and it's a right here in Riverside County, Moreno Valley, and the owner works just like his staff. He literally sits down every day in his office and pretty much plants himself there from morning until night, trying to do loans just like his loan officers.
Yes,
and I was going to say one other thing, and when you're out there picking a lender, I would suggest that you at first try a direct mortgage lender. The advantage of that is that for whatever scenarios that you might have, a direct mortgage lender has underwriters in-house where they literally can take your scenario, sit down with that underwriter who's going to eventually approve or deny your loan, and talk about it up front. It can save you time and it can save you money.
Perfect. Yes, that is a plus. People are still worried about mortgage brokers, so that's great. Sit down with a direct lender. Also, his company has been in business even through the storm. He did not get shut down. He is still going strong, very, very strong. That's something that you should take a look at as well, because I know a lot of people are very nervous about who they decide to use for a mortgage lender. So those are just some great things you should look at and see that all his agents have been in business for years. They have not just started, and I know there's some new people out there, don't get me wrong, not that they don't know what they're doing, because we all have to start somewhere. But for those of you that are a little leery and want to know, well, should I not, at least you know they have many, many years of experience under their belt and they're able to help you.
Yeah. I would say, and just for speaking for the mortgage industry in general, and even on the real estate agent side, going through this storm, you will find now that you will find realtors and mortgage consultants more knowledgeable. We have more guidelines, more educational courses that we have to go through. So the people who stuck with this, you'll find them more knowledgeable about their business, and you'll find that they're tougher, that they're willing to walk you through this process, and to help you get what you're looking for.
Yes, yes. And being in real estate for the last 9.5 years, it has been definitely a tough market. Even this year for me, it's been pretty tough. But it's only the strong will survive. So that's something that is very important when you're trying to decide who you're going to work with, and make sure whomever you work with, whether it's a lender or with a realtor, make sure they have a team of people behind them that can support them and that can help them and help you through your process, because you don't want your process to be tough. One thing about me is when I'm out with a buyer, I want to make sure that they are working with a lender that works for them and not just works for themselves. It's not always about the money, because there's going to be some instances that I'm able to help someone to a certain point and I can't go any further because there's some things that they have to work out. I'm in it for the long haul, and so is Brian. So make sure you reach out to Brian. His information will be posted, and you can also go to briansapp.info to his website in order to find out more information, to fill out his contact us information. He can contact you and see what he has going on his website and sign up for his information. He sends out really great information about the market, and it keeps you abreast at all times. Thank you so much for those that are watching. If you have any real estate questions, if you know someone that is in the process of thinking of purchasing a property, let them get in contact with myself. I'll get them in contact with Brian or vice versa. Let them know you've seen Brian on Comma Speaks so we can know where the lead came from, and we appreciate all referrals. We love referrals. We love referrals. So make sure that you send them our way. If you have someone that is in the process of losing their property, and they want to walk away, there are too many people that are still walking away from their property, have them give me a call so we can go over their options. They may be able to do a loan modification, and if not, at least have a peace of mind of what the next steps are. They may have some equity in the property that they're able to sell. So don't just walk away. Exercise all your options that you have out there. And to get in contact with me, just go to commaspeaks.com, or you can call me at 951-867-7766. Again, that's commaspeaks.com or 951-867-7766. For those out there that are watching, thank you so much for watching. Keep spreading the word. Real estate is still thriving. It's one of your biggest assets. Make sure you ask questions before you just give up or not know. And always talk to a professional. Please talk to the professional. Stop talking to your neighbors, your family members, your lawyers, and all these people that are not practicing real estate. Talk to the professionals. Thank you so much for watching.